What's up everybody, Gen X Dividend Investor here. In this video I share what the best and worst times are to be a dividend investor, and I'll close things off by responding to a subscriber question that I think a lot of people would value from hearing, so I encourage you to stay until the end. And before I start, I should preface this by saying that I've been retired for almost 4 years and left the 9-to-5 thing once my dividend income was more than my expenses. I tell you that to be aware that I'm kind of biased towards dividends because they've been such an amazing part of my life. Okay, so to kick this off, one of the best times to be a dividend investor is when you realize that you really want truly passive income. That desire can fuel your investing habit, helping you through times when markets crash. Dividends aren't guaranteed, but they are the best way I've ever found to get cash flow coming in without you trading your time for money. I mean, when people talk about passive income, they'll mention writing a book and then getting royalties, or buying a property and renting it out, and all of those can generate income, but to me nothing is as easy as clicking a button on an app and placing that buy order. Of course, you had to have gotten money from your job or somewhere else to be able to buy some dividend stocks in the first place, but once you buy them, they can truly be recurring passive income. Anyway, historically speaking, we've seen that one of the best times to be a dividend investor is when the markets crash or go sideways. For example, in a 2019 blog post called Dividend Growth Strategies and Downside Protection, Philip Brzenk, the global head of indexes at S&P Global, examined the performance of dividend growth strategies during periods of negative market performance. He found that since the end of 1989, there have been 6 years of negative performance for the S&P 500, and in all of those years, the dividend aristocrats outperformed the market by an average of about 13%, which means they were less negative, on average, and in fact had positive returns in 3 of those 6 years. So the S&P 500 dividend aristocrats outperformed the S&P 500 53% of the time by an average of 0.16%. When isolated to down markets, the dividend aristocrats outperformed over 70% of the time and by an average of 1.13%. But in up markets, the dividend aristocrats underperform 56% of the time at a lower average magnitude of negative 0.34%. Brzenk concluded that the dividend aristocrats have delivered downside protection in months when the S&P 500 lost ground. Of course, markets have historically tended to be up more than they are down, so an advantage in down markets doesn't necessarily translate into an advantage overall. And there are exceptions to all that, but it's understandable that conservative stocks will probably be less volatile than more risky stocks that can see bigger swings up or down. Brzenk also found that the lower the return of the S&P 500, the better the relative performance was for the S&P 500 dividend aristocrats. So the more negative months we have, i.e. the worse the market is, the better those blue chip dividend stocks tend to do, relatively speaking, as compared to other stocks. Another example which says that dividend stocks perform better in weak markets is shown in this data from Hartford Funds that highlights S&P 500 index performance on a decade-by-decade basis. During the 1940s, 60s, and 70s, i.e. decades in which total returns were lower than 10%, dividends played a large role in terms of their contribution to total returns. By contrast, dividends played a smaller role during the 50s, 80s, and 90s, when average total returns for the decade were well into double digits. And in cases like from 2000 to 2010, aka the lost decade, where the stock market basically went sideways, dividends ended up being the only source of positive return, broadly speaking. Part of what happens is that as crashes occur, stock investors often turn to fundamentals rather than hype, and they pour their money into more sure things like quality blue chip dividend stocks. So crappy markets are often a great time to be a dividend investor. That being said, when markets are shooting up, it can still be good to be a dividend investor. Multiple studies have shown that dividend stocks have outperformed non-dividend stocks over broad periods of time. Like this graph highlights how over approximately the last 50 years, dividend growers and initiators return the most, on average, versus the equal-weighted S&P 500 index or as compared to companies that don't pay dividends. And speaking of an equal-weighted S&P 500 index, as I was working on this section of the video, I saw a note published on Wednesday where Bank of America suggested that investors should decrease their small, mid-cap, and mega-caps, and instead focus on the equal-weighted S&P 500. They pointed out that much of the market's gains have been concentrated in a handful of mega-cap stocks, aka the Magnificent Seven. But excluding those, the S&P 493 is now on track to grow earnings by 8% year over year in the second quarter, marking its first quarter of earnings growth since Q2 of 2022. Meanwhile, small-cap stocks remain in an earnings recession that began in Q4 of 2022, with the S&P 600 showing an 11% year-over-year decline in earnings so far in Q2. Bank of America said that rising recession concerns hit small caps harder if history is a guide. So basically they said that the equal-weighted S&P 500 is currently trading at an extreme discount to the market cap-weighted S&P 500, nearing levels last seen during the tech bubble. Anyway, because dividends come from companies that are generally the steady eddies of the business world, dividend-paying stocks have historically been less volatile than the broader market and their non-dividend-paying counterparts, which has helped them outperform. That being said, companies that cut their dividend or eliminated their dividend often perform the worst. I did a quick analysis recently and found that over 80% of the Fortune 100 pay dividends, so it shouldn't be surprising that blue chip dividend stocks often outperform because you're talking about some of the best companies in the world, as opposed to the broader market, which tends to include more financially distressed stocks. And if you're wondering if dividend outperformance is limited to US stocks, the answer is it isn't. Here's a study called Dividend Investing: Strategy for Long-Term Outperformance by Michael Clemens, done in 2012, which found that dividend investing has historically outperformed both the broader market and value investing, and at the same time shown lower risk. The study included data for markets around the world, using a Dogs of the Dow framework to evaluate returns versus their respective indexes. I did a video about Dogs of the Dow in case you want more details about it. All that tells me that maybe it's always the best time to be a dividend investor, at least if you can identify quality companies and if you can buy them when they're inexpensive. But to be fair, if you're someone who just focuses on dividend income and you ignore where that income is coming from, then I'd say that would be one of the worst times to be a dividend investor. What I mean is that you need to understand if a company can realistically sustain paying and growing their dividends, and if you only focus on yield, you could be shooting yourself in the foot. You need to be aware that dividends aren't free money, even though they can feel like that, and I've done an entire video explaining that point. You also need to understand how taxes work with dividends, and you need to make sure that your company is generating enough revenue and profit and such in order to continue paying dividends. If they can't do that, then your success with dividend investing is obviously hampered. Now, a great time to be a dividend investor is as you get older, because time becomes something you tend to value even more, and the true passive nature of dividend income can free you up to do what you want with your time. Older investors also often want less risk in their portfolios because they have less time to recover if something goes wrong, and dividend portfolios often do that. Plus, older folks often have less ability and desire to work at a job if their stocks end up not working out. Now, of course, young people can be successful dividend investors for sure, though they should be focused on stocks that they think will yield them the best total returns and not only focus on dividend stocks. And then as you transition into retirement, then many investors focus less on total return and more on income generation along with capital preservation. Like now in retirement, I have a couple of income ETFs to gas my income, but I'd not recommend owning those when you're young and trying to grow your net worth. Dividend income ETFs can appreciate in value, but odds are they won't go up as much as broad market ETFs over the long run. Another great time to be a dividend investor is in low interest rate environments. You see, when interest rates are low, bonds and savings accounts typically offer lower returns, making dividend paying stocks more attractive to investors. Investors often turn to dividend stocks for better income, which can drive up stock prices and provide capital gains along with dividends. My personal hope is that we'll continue to see interest rates trend down as they have been, all of which should act as catalysts for dividend stocks to prosper more. In fact, a few hours ago I tweeted that the consumer price inflation percentage just came out for the last month at a nice low 2.9%, which is the first time it's been under 3% since March of 2021. More and more people are anticipating a rate cut in September, which should be good news to us dividend investors. Of course, that also means that high interest rate environments are often less good for dividend investors. Moving on, a great time to be a dividend investor is often after we have a crisis and markets are going into recovery. You see, after a financial crisis or economic downturn, companies that have weathered the storm often emerge stronger and tend to resume or increase dividend payments. Investing in these companies during the recovery phase can be rewarding. And then once we get to a stable or growing economy again, then companies are more likely to generate consistent profits, which can lead to stable or increasing dividend payouts, which can become an ideal time for dividend investors, as companies are less likely to cut their dividends. So investing during periods when companies are increasing their dividend payouts can be highly beneficial. And companies that consistently raise dividends often signal financial health and a commitment to returning value to shareholders. Of course, for companies to be able to grow their dividends, they need to be growing their earnings, which is why I did a video I recommend everyone watch called Why Earnings Are Critical to Dividend Investors. Take a listen to this 30-second clip from legendary investor Peter Lynch to understand why earnings growth is so important.
I don't think people understand there's 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company, right, the stock has done very well. People worry about too much money supply, what's happened to the price of oil, whether, who's the president, who's being nominated for the Supreme Court, it's all the ozone layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
So one of the best times to be a dividend investor is when you're investing in quality dividend companies at reasonable prices that have growing earnings and a solid track record of historic dividend growth, coupled with your belief that the future continues to look bright. A riskier time to be a dividend investor might be in huge recessions, as companies may experience declining profits and cash flow, all of which could lead to a dividend cut or suspension. And then obviously dividend investors can suffer from reduced income and declining stock prices during those periods, but it all depends on what you own. I have some stocks that have increased their dividends each year for longer than I've been alive, so great companies are often able to make it through bad markets and recessions and can keep their dividend streaks alive. Plus, during market downturns, many dividend-paying stocks may drop in price along with the broader market. This can actually be a good opportunity to buy high-quality dividend stocks at a discount, assuming the companies are financially stable and can maintain their dividend payouts, all of which can mean that recessions can be one of the best times to be a dividend investor. Though one of the worst times to be a dividend investor can be if you're investing in stocks that are creating a market bubble. Even though dividends may be attractive, if stock prices are overinflated, the potential for a significant market correction can wipe out your gains. If the bubble bursts, the resulting market crash can lead to a sharp decline in stocks, though the quality companies will probably lose less, and the good ones will continue to pay you dividends while you hold them and wait for the markets to recover. And waiting and holding is a lot of what dividend investing is about. I like to think of my dividend stocks as cash trees I've planted, and now I'm waiting for each harvest period when they pay out. Each month or quarter I can harvest more income, and my trees usually grow over time, yielding me even more income as they do dividend hikes. Sure, some of my crops might sometimes die, but as long as I keep holding and planting decent stuff, then my income and potential for growth should keep increasing. A potentially bad time to be a dividend investor is if your companies are highly leveraged or face a debt crisis, in which case they may prioritize debt repayment over dividend payouts. In such scenarios, dividend cuts or eliminations are much more likely, negatively impacting dividend investors, at least from a dividend perspective. And again, a precursor to having all these benefits, as well as hopefully avoiding negatives, is if you're able to identify quality dividend growth stocks that are on sale, and if you can, then that's probably a great time to be a dividend investor. Quality companies often return cash to shareholders in the form of a dividend, and they usually don't pay a dividend unless they have confidence that they can keep paying one, because the market usually expects companies to continue to pay dividends once they start paying one. Paying a dividend often attracts a certain type of shareholder, so if you stop or cut your dividend, those shareholders will penalize you, often by selling. So once a company makes the decision to pay a dividend, it's kind of like they're getting married to a certain type of investor. And if they cut or stop paying a dividend, then they're setting themselves up for some divorces, as a business professor once said. And as you look for quality companies, you want to make sure they can continue to grow. Stock appreciation and dividend appreciation is usually based on growth, ideally predictable growth. The more volatile and unpredictable earnings become, the less dividends tend to make sense, and instead buybacks make more sense. A question some people ask is, what about macroeconomic conditions with volatility? Well, when they're more volatile, then companies may keep driving more cash flow into buybacks instead of dividends, or they might start doing more special dividends instead of fixed dividends. Okay, another great time to be a dividend investor is when you have a retirement account and you turn your DRIP on, and you can let time and compounding grow your dividend snowball to unbelievable amounts. It's super motivating to see your DRIP continually buy more of itself, and with each payout you can see your dividend income go up, and things tend to keep growing faster and faster. Plus, you basically have no tax issues to worry about, and decades of compounding can literally do amazing things to your portfolio. A bad time to be a dividend investor is if you're looking to get rich quick. I promote a get-rich-slow method, so you're barking up the wrong tree if you're hoping to get rich quick. So are dividends inherently good? Well, I think that depends on your goals and needs and such. I like them, but in the end they're just a way to return cash to shareholders, and for certain folks, like me, dividend income is also appealing because the current tax laws are beneficial to people that don't have wage income. Plus, I think if you'd like to pass your cash flow generation onto others, like your significant other or kids or charity or whatever, and those others might not be as versed in stocks as you are, then it can be great to be a dividend investor. It brings me a lot of happiness knowing that my dividend income will keep pouring in even if I'm not here. That all being said, just because a company doesn't pay a dividend doesn't mean you should avoid investing in it. I mean, Amazon doesn't pay a dividend, but they've been a heck of a company. My TLDR is that dividend investing is often less bad in bad years and is often good in good years, so there's no time like the present to start investing in quality dividend stocks. Okay, now I'd like to switch gears and respond to a subscriber's question on my last video, which I think everyone would find useful to hear. Specifically on my video called Portfolio Down 73,500 in One Day, Dividend Income Up to $128,182 a Year, a user named StJohn2711 asked, how does one determine if the index is expensive and that there aren't any attractive bargains to be found? So I think he's asking two things. Number one is if there's a way to determine if the overall US public stock market is expensive, generally speaking. And number two, are there any individual companies that are inexpensive right now? Because Buffett has said that he wants to find deals to invest in, but can't find any attractive ones. Let's start with number one, and when most investors in the US are talking about the markets being expensive, they tend to focus on the S&P 500, which tracks the stock performance of the 500 largest public companies listed on stock exchanges in the US, and either SPY or VOO are two tickers that people commonly think of. Of course, perhaps he's talking about the Wilshire 5000 Total Market Index or something like VTI, each of which tracks around 3,400 companies, but I'll assume he meant the S&P 500. One useful source I've found to check is the Wall Street Journal, which has this publicly accessible information showing the S&P 500's PE ratio, both at a trailing 12-month level and a year ago trailing 12-month, and includes a forward estimate, which tends to get updated weekly. Right now we can see that the S&P 500 is around a 23 PE, which tells me things are expensive relative to historic norms. Like here are the last 25 years of S&P 500 PEs, and I'd eyeball that its average has been around a 16.5. So the 23 we are currently at tells me that things are probably expensive on average. It's possible that different markets can cause PE averages to materially change, but I think a 15 to 17 market PE is probably a reasonable guesstimate for if things are expensive or not, broadly speaking. Let's cross-check that Wall Street Journal PE data with another source I like to use, FASTgraphs, which I'm an affiliate of. FASTgraphs is primarily about individual stocks, but I noticed that it has SPY's ETF in it, and I think they mentioned once that they might get more ETFs in the future, but don't hold me to that. This says that the average PE for the market is 23.65 right now, which is basically what the Wall Street Journal says. The data also shows me that over the last 20 years, the normal PE ratio has been a 19, so if SPY's overall price was on the blue line, then I'd say things are reasonably priced. If it's above the blue line like it is now, I'd say it's probably expensive on average, and if its black price point was below the blue line, then I'd say things are looking cheaper. An even more conservative investor would argue that a 15 PE is a reasonably priced market average, so anything above the orange line in this particular graph would mean more expensive, and under it would mean the market is looking cheap. Of course, the beauty of investing is that there's pretty much always companies that are inexpensive, even when the overall average is expensive. You can often do calculations like discounted cash flows for a company to determine if it's expensive or cheap, or you can use a tool like FASTgraphs to help you figure that out. If you'd like me to do an entire video on how to value a stock, then leave me a comment telling me so. I used to do DCFs, and I built automated calculators to help me out, but now I prefer FASTgraphs because I can easily type in a ticker and glean lots of information about it, which leads me to the subscriber's other question about inexpensive companies and what Buffett said. Now, one thing you need to realize is that when Buffett invests in something for Berkshire, he has different needs than you or I tend to have. He's looking for things that move the needle for Berkshire, and that is a totally different beast than what might make sense for our individual portfolios. There are lots of inexpensive tickers out there these days, and I talked about a few of them in a video I did a couple weeks ago called Cheap Dividend Kings. And with that, I'd ask that if you got any value from this video, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to shout out the right one, who just signed up as a Patreon King for an entire year, which gives her all the benefits of my Patreon champions and aristocrats, as well as allows her to chat with me once a month on a private voice chat on my Discord server to talk about whatever she wants. Next, I'd like to suggest that everyone consider using my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend that you check out my Seeking Alpha affiliate link, as new users can get good discounts for signing up. Plus, take a look at my Patreon seats to see if there's any you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you can get. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 82 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.